Let's get into it. We'll start with market performance for the week ended October 6th. Just looking here at the last week, kind of a mixed week, some pockets of green, particularly in large cap, particularly in growth. Taking a look at the year-to-date column, still seeing a lot of green there. But we've introduced this new column for our viewers here this week, since 8-1. Mike, do you want to talk about the relevance of that 8-1 column?
We just thought we would throw in the column. This is basically since the market reached year-to-date highs. And so it's always interesting to see, since those highs, since we have a bit of a pullback here, what's been holding up better, what's been, falling harder. And you'll see since August 1st, most would say not surprisingly, but it is a bit surprising to us, is large growth is actually holding up the best in the downturn.
Yeah.
They obviously are leading the way higher. And of course, this once again speaks to the Magnificent Seven. They're all in this large growth bucket, and they've been hanging in there and really supporting the S&P 500 and other market weighted indexes.
Yeah, and that Magnificent Seven, very colorful, interesting chart here. So Magnificent Seven, we're sitting here earlier in the year talking about how the Magnificent Seven is accounting for nearly all of the S&P 500's price return in the first half of the year.
Yeah.
And we can see that's kind of changed since then, but we got right back to that same point. Do you want to talk through the past 2 or 3 months here from a Magnificent Seven perspective?
There was a narrative once we got into May and June that this equity market rally will likely broaden out. It was a rolling recession. The banking fears were overblown. Agree that there's narrow leadership in the market, but the next thing to happen is small caps or the other 493 stocks in the index, which we have here in orange, they're going to be the ones leading the way higher now that recession risk has decreased so much. And that played out for a few months, but now that narrative is totally gone. The other 493 stocks as we sit here today, on average, have a negative return. They are detracting from the year-to-date return on the index, and we're back to the point where more than all of the gains for the S&P 500 year-to-date are just from those Magnificent Seven stocks.
Yep.
So the hopes for a broadening out market rally, FOMO-led rally, those have been squashed. And so now we're in a place where, the prevailing narrative here is, these Magnificent Seven, they're unbeatable.
Yeah.
Should own more. What's the word I'm looking for? Invincible, perhaps. Invincible, perhaps. So what we wanted to do is sum up the narrative around the Magnificent Seven as succinctly as possible. Right. Give us some liberty here. I'm sure there's more narrative than this, but basically it sort of goes like this. These are the best companies in the world, right? They represent almost a quarter of the S&P 500 index, but I should own more of them.
Yep.
See the first point, right? They're the best companies in the world. And you can't beat the S&P 500.
Of course not.
Right? So we wanted to sort of take each one of those one by one and just talk about what the historical record says. We've been in this place before.
Right.
History doesn't repeat itself, but it sure does rhyme. There have been other times in history where a few stocks have dominated a market cap weighted index, right? So let's take the first point. These are the best companies in the world. We're not even going to debate that. All right. The point is, great companies can become bad stocks if they get too expensive. And expensive is a relative term. So relative to what? And it almost doesn't matter what you're measuring these 7 companies relative to. They are expensive. If you wanted to be bullish, you'd probably point to something like next year's earnings. You say 30.5 times next year's earnings, thereabout. That is expensive. That's a premium to the market. But going back to the point, these are the best companies in the world. They should trade at a premium.
Sure.
Right? But you have to take that in comparison to the prevailing interest rate environment. If you're trading at 30.5 times next year's earnings, and these are really the only stocks in the index where those earnings expectations next year are going up, so you're 30.5 times a large number and growing number, right? If you're 30.5 times, turn that into an earnings yield. So you do 1 divided by 30.5, you get an earnings yield of 3.3.
Yeah.
Compare that to a risk-free cash yield of 5.3. And now these things are extremely expensive, these stocks, extremely expensive relative to the alternative. They're also all growth stocks. Growth stocks are somewhere in the 90th percentile of expensiveness based on our valuation signal, right?
Right.
So yes, great companies. They could be so expensive that they are not good stocks to own going forward.
Yep.
Right? So that's the first point. Next point is I should own more of them.
Maybe I shouldn't own anything else.
Maybe this is all you should own. So once again, what does the record say? Well, every decade, if you were to look at the top 10 stocks in the S&P 500 at the beginning of the decade, 10 years later, on average, 6 or 7 of those stocks are no longer the top 10.
Right.
Right? Because it is true that companies can get too large. They can get so large that new regulations get introduced. They run into antitrust issues, product saturation, competitiveness, just gravity sets in, right? And on average, 6 out of 7 of those top 10 names turn over every single decade. So should you own more of these? Well, we would argue 10 years from now, the index is going to own less of them. And so you might want to own less of them before that, right? If you're looking at generating returns going forward. And then the last piece, you can't beat the S&P 500. That's just, we're not saying it's easy, but to say you can't do it, we think this chart really speaks to that.
Yeah.
Right?
Yeah. So what we're looking at here in the blue, you've got the S&P 500 index, like you see on TV, the standard index weighting and performance. We're comparing that in the light blue line to the equal weighted index. So let's recall the S&P 500 market cap weighted. The bigger a company gets, the bigger the weight it has in an index. All we're doing here in this light blue line is taking all 500 companies and giving them a 0.2% weighting and calculating that performance. So, first thing that jumps out on this page, you can beat the S&P 500 if you just equal weight all your holdings. That's what's happened since the inception of this index. But maybe if we want to dive in a little bit further and talk about, why do we see periods like this where the S&P 500 is outperforming that equal weighted index?
Right. You can't beat the S&P 500. The S&P 500 market cap weighted index is just a momentum strategy.
Yeah.
Momentum inherently works until it doesn't, right? When does momentum work? Well, it works through the end of a market cycle.
Yep.
And then it stops working.
Works the other way.
At the end of the market cycle, right? And it works against you. So, we've seen this in the early 2000s, right before the tech bubble burst. That's once again where the S&P 500 got very top heavy, very concentrated. A lot of those top 10 holdings were not the top 10 holdings in 2010. Right? A lot happened over that time period. And you see the market cap weighted version of the index perform very well. And then it didn't.
Yep.
And if you were invested in those top 10 holdings, you would have suffered some really, really ugly returns following that, right? Because these companies, great companies, got too expensive, right? And you see that play out through other cycles as well. But, what we think this speaks to is, yes, these are great companies. Yes, they've done very well. But we think, and what we're doing with clients, we should be looking to diversify out of them, right, into the alternative. Value stocks are cheap and reasonable. Smaller cap stocks are reasonably priced. More importantly, fixed income are the most attractively priced literally in decades. That's what investors should be focusing on. We want to be focused on where the puck's headed. Right? Not just latching on to year-to-date performance of these 7 companies and how incredible or magnificent they are.
Right.
Yeah.
Exactly. And to that point of, relative attractiveness of fixed income yields, we can see a little bit of that in this chart, right? With negative performance being a result of yields rising. The more difficult performance is on the fixed income side, the more attractive your yields look going forward. So, similar idea here last week, tough week, particularly in the long end of the market. You see the 30-year treasury down over 4%. We've included that same 8-1 column for our viewers here on the fixed income side. Anything else you want to hit in on the fixed income performance?
Yeah, eventually the current yields become so attractive that you get a rotation out of equities or things that seem expensive into these assets which seem cheap. And one of the counter arguments to that, obviously we'll talk about the macro later, but just sort of valuation technical arguments is, well, that's great. I can get, a 5% yield on a 2-year or a 4.8% yield on a 10-year.
Yep.
But that 10-year bond is paying me coupons
Reinvestment
throughout
risk.
the life of the bond. So I have reinvestment risk. Yes, short-term yields are high now, but what if they come down later? Then when I'm receiving those coupon payments for my 10-year bond, I have to reinvest them at lower rates. I'm probably not going to get that full 4.8% yield.
Yeah.
But, we're at the point now where if you just wanted to lock it in, you could buy a 10-year Treasury strip, also known as a zero, but this is a bond that does not make coupon payments, right? It just gives you a principal payment at maturity.
Yep.
The yield on that type of a security right now is 4.93%. So you could, if you wanted to, lock in a 4.93% annualized return over the next 10 years with no investment risk.
Yeah.
Or reinvestment risk, excuse me.
Right.
The only investment risk you would have, of course, is if the United States government ceases to be
Doesn't pay you back
in 10 years and you don't get paid back, which is a low probability event, we would say. So the yields do become attractive enough that they start to suck money out of the expensive areas of financial markets. And, we think we might be getting to that point,
It's just incredible thinking back to 1, 2, 3, 4 years ago, in a world of a 4% withdrawal rate planning for retirement. If you could tell a soon-to-be retiree, hey, hang on just a second, the 10-year strip is going to be nearly 5%, and you can lock in that return for a 10-year time period. It's just, that change has been so significant.
Right.
Hard to overstate.
The math's really easy.
Yeah.
When you get those types of yields.
Right. It starts to work out a little bit better, huh?
Yep.
Cool. So we'll wrap up with alternatives here. Some more red on the board. One of the worst performing sectors, energy. Obviously, a lot going on geopolitically. Anything we want to dive into there?
Just the Israel-Hamas conflict. Obviously, one of the most immediate impacts where you would see that in financial markets is within the commodity space, particularly within energy. That's not reflected in these numbers because these are all through last Friday, which obviously was right when the conflict was starting. And we've seen a bit of an increase in Brent and WTI crude oil prices, but absent any further escalation across the region, we wouldn't expect this to result in a substantial increase in oil prices. Right. Now that's a big, that's a big caveat. Sure. Right. So this is something we don't know how it's going to play out. But, crude oil prices have popped back up. More importantly, let's take out the noise, look at the signal. Crude oil prices are much higher than they were last fall. Right. And it's going to make inflation stickier going forward. This certainly does not help that. So we'll get to that later in our inflation forecast. Yeah. All right. So with that on market performance, we can get into this week's big macro news from our perspective. That would be led by the September jobs report. So headline, non-farm payrolls added significantly above expectations. But in response to that, the market is saying a November rate hike from the Fed is actually a slightly lower probability than it was before that jobs report came out. Yep. So what's going on there? Yeah. Well, I think it speaks to we need to take a more holistic view looking at the labor market. It's much more complex than any one data point, and all of these data points are heavily revised. So we wanted to bring you all into how we look at the labor market. We look at it in a heat map fashion. And we've broken out our favorite indicators, and we're going to talk about how we think about it. So up top, these are our supply and demand indicators. Supply and demand for labor. That's what ultimately determines where we're at in the economic cycle, right? And for all these indicators, we scale them red meaning tight or hot, and blue meaning soft or cool, right? And if we look at things like the unemployment rate, the unemployed per job openings ratio, and labor force participation rate, these things are hot. They've been hot for a really long time. Yep. This is why, in our view, you have to agree we are late cycle. There just isn't a lot of room for overall employment to increase at a faster rate. And we saw this in the jobs report this month. Leisure and hospitality type jobs are back up to staffing levels pre-pandemic now. Yeah. So you think about where is there room left for more people to get employed. Maybe there's a touch of slack from folks not currently in the labor force, but that's minimal, right? So we're late cycle, okay? We think that's true. And this is what the Fed's worried about. There has been insufficient supply and or too much demand for labor for a very long time. And that passes through to wages, which we have at the very bottom, right? You look at any measure of wages or the quits rate, which is a great leading indicator of wages, they've been in hot territory for quite some time. And that's what the Fed's worried about. Now we're talking about wage price spiral, creating an inflation problem. That's a problem the Fed needs to solve. And so we're looking at then, if the Fed's going to solve that problem, where are we going to start to see that pick up? That's what everybody's waiting on.
Yeah.
Because if solving this problem means softening the labor market and increasing unemployment, that could result in a recession.
Right.
Right? So we would see that play out in hiring and firing. And that's what we're watching very closely. And you start off with hiring, non-farm payrolls. We're looking at the 3-month moving average of the month-over-month change, 266,000 jobs added.
Yeah.
Right, over the last 3 months. That's a reacceleration, right?
Yep.
That has to concern the Fed. You look at the revisions, ADP private payrolls. ADP private payrolls and household employment last month were much lower. We're talking about in the 80,000s months over month. So they're giving conflicting signals. That's also why we look at the 3-month moving average. And you are starting to see some softening there, right, in alternative measures of employment. So a bit of softening, but overall, some hiring, not a lot of hiring, certainly a less robust hiring environment than we had last year, right?
Yeah.
So we're seeing hiring slowing. It's tough to see, but it is happening. You have to look at all the data. And you're also not seeing a lot of firing.
Right.
Right? Low hiring, low firing, which is a low growth environment, right? High hiring, low firing is a high growth environment.
Right.
Low hiring, low firing is more of sort of a freeze. You all may recall, if you're regular watchers of our videos, if you go through the first 6 months of the year, we did see some cooling in terms of initial jobless claims increasing. We're looking at the 3-month change. This is of the 4-week moving average. But that has since stopped. The firing has stopped as well.
Yeah.
So we think the Fed would look at this report and they wouldn't necessarily base a monetary policy decision just on that hot non-farm payrolls number.
Right.
Because if you look at the totality of the information, it hasn't changed a whole lot over the summer.
Right.
Right? And they still need to soften it, but they think monetary policy is in a restrictive enough place that it should start to soften naturally. But either way, late cycle, lower growth, slower growth going forward, in our view.
Yeah. So to just summarize that labor market outlook, labor market still tight, unlikely to be a driver of economic growth in the near term from an expanding labor market. But on the flip side, the Fed is actually probably still looking to cool the labor market a bit more due to these wages rising.
Exactly.
Right.
Exactly.
So with that in mind, let's get into the framework, economic growth.
Yeah, calendar Q3 is in the books, but we get the first measure of Q3 GDP at the end of October. If that comes in line with the Atlanta Fed GDP now forecast, then we should touch the long-term median number. That is, for us, is our high or low point. We're always talking about high or low, rising or falling. That's our high low point. But then from there, we do see a pretty sharp slowdown in real economic growth for those factors you already talked about.
Right.
Slowing hiring being a big thing. We also talked about excess savings being depleted. That's also a factor.
Right, absolutely. And then on the inflation front, continuing to see, our forecast calling for sideways inflation, a little bit of volatility in the forecast period. Mm-hmm. Anything else notable on the inflation front?
No, it hasn't changed a lot there.
Yep. Awesome. And then liquidity. So here we got a question from one of our listeners, which we always appreciate, and we wanted to, certainly address that question. The question being, what happens if the Fed decides to sell mortgage-backed securities? What could that potentially do to inflation, equity prices? What are our thoughts there?
Yeah, great question. Right now, as a reminder, as part of the Fed's quantitative tightening program, they will allow up to $35 billion of mortgage-backed securities on their balance sheet to roll off their balance sheet in any given month.
Yep.
Right? So if in a month 60 billion of MBS are maturing, they would let 35 billion of that run off the balance sheet, not reinvest those principal payments, right? But the other $25 billion, they would have to reinvest.
Yep.
Okay. So the Fed is not selling. The Fed has never done an outright sale of long-term securities that they hold on their balance sheet. Okay. So what would happen if the Fed decided to sell MBS? Well, I think that's answered by the reason why they don't do it.
Yep.
Right. And they don't do it because they're afraid of creating market instability. The Fed does not want to be moving markets.
Right.
If they were to step in and start selling, they could be one of the biggest sellers in the mortgage-backed security market, right? And that would create technical issues and create market instability. And who doesn't like market instability? Equity investors. So we think there would be immediate knock-on effects for equity markets. Equity markets would not like that at all. This would be, it would be a sea change in policy.
Yeah.
Right? To think that the Fed is now not only the buyer of last resort, but a seller of first resort.
Seller of first resort.
That could be very disruptive, right?
Yeah.
And in terms of inflation, well, you think about the knock-on effects of if they're selling in the MBS market, what does that do to the pricing of mortgages? It's going to make them higher, right? So mortgage rates climb, and then any progress that the Fed has made on housing in order to slow shelter inflation, it would accelerate that.
Yeah.
It would make this liquidity chart feel worse in terms of market outcomes, economic outcomes. Yeah. They talked about doing something like this last year. In hindsight, they probably could have, right? I don't know if it would have made it that much worse or better, but they clearly did not, and we don't expect them to.
Yeah, yeah, makes sense. Thank you again for that question. We certainly appreciate it and look forward to those. We'll wrap up on the framework front, just checking in on our recession signal. We talked about labor market signals. You can see, really only continuing jobless claims active there. But one thing we did wanted to point out just briefly here, we can dive in a little bit deeper in coming weeks, but we are starting to see some market stress signals, some starting of that to where, we're looking at the S&P 500 index to be down 10% or more. That's at 6.1%. And then looking at credit spreads, both IG and high yield bonds about halfway to their signal trigger thresholds. So starting to see some signs there, but nothing to trigger the recession signal just yet. So that'll do it again for us this week here at STRAT This Week. If you have any questions, please feel free to reach out.